We are now checking in on Kohl's because there has been some strange market moves today, to say the least, Katie. You're still seeing the stock up almost 30%. It's roughly the biggest gain since January of 2022, but earlier today it did have the biggest gain on record and has added almost $350 million to its market cap. We're going to get some more details now from Bloomberg specialty retail reporter Lily Meyer. And there's a lot of questions about how much retail interest is being drawn to the stock, about whether there's a short squeeze. The short interest was pretty meaningful, bigger than that even of GameStop. Is there anything fundamental about this company that would drive this kind of a move?
Yeah, I mean, a lot has happened for Kohl's this year. Its CEO was fired after the board determined that he had directed millions of dollars to business, to someone he had an undisclosed personal relationship with. The company's in a turnaround. It's really struggled to bring in customers. Sales has declined for more than 3 years. So it's been a rough year so far for Kohl's.
Absolutely. Amazing that was just this year that scandal, if you want to call it that, happened. And you have the difficult task of trying to talk about fundamentals in what appears to really be a meme moment. But give us the lay of the land. There were some bankruptcy rumors circulating on social media, for example, this morning. Is there any validity to that claim? Should this company be on that sort of watch list?
Yeah, I mean, I haven't heard anything to give validity to those claims, but I think the company has struggled with sales, as a lot of retailers have recently. But sales have been down for more than 3 years, and it's really trying to reinvent itself and stay relevant to its customers.
So what are the catalysts we should be looking at when it comes to Kohl's?
I think some of the catalysts would be if it's really able to bring customers back in. So some of its goals have been to refocus on fundamental areas. It's focusing on areas like fine jewelry. It's started to have partnerships with Sephora and Babies R Us. So I think focusing on seeing whether those have started to work and bringing customers will be really interesting.
Yeah, we're still over a month away from this company's earnings report. So a lot of questions that we need to wait for answers for. Lily, really appreciate you stopping by. That is Bloomberg's Lily Myers talking about Kohl's, which has just been going crazy this morning. As Shanali said, was higher by as much as 100% earlier today, but has since pared some of that gain and has been halted for volatility a few different times.
You know, it's not alone. I shot a note off to Citadel Securities while we were talking here to see, give me the data here. Give me how strange it is in the meme stock market. Open Door has also been soaring year to date, but in the last couple of days, a little less today. Coming up, we're going to just talk about normal way course of business. We're going to bring in Fifth Third Bank CEO as we watch the regional banks. This is Bloomberg.
We need to ensure that all the different pieces of the capital framework work together effectively. Doing so will help maintain a safe, sound, and efficient banking system for the benefit of the people we serve.
That was Chair Jerome Powell speaking at the Federal Reserve earlier this morning because it's hosting a conference today to discuss the future of the regulatory framework for the banking industry. And joining us, Bloomberg's banking regulation reporter, Katanga Johnson, at the conference. He joins us now. A lot is changing. You know, one thing that's kind of stunning me a little bit here is that the rules are already set to be less strict than they were originally planned. The banks are clearly wanting much less tightrope here to be walking over. They want to have a full slate to be gliding through. How much more can things be relaxed from how much they've already been planned to be?
That's really an interesting question. That's the focus of the conference today. Regulators are hearing from a range of banks and academics and advocates who say that certainly new rules shouldn't be more onerous, they shouldn't be more strict. But regulators are cautioning, and we heard it in Powell's speech this morning, that the amount of capital in the system right now is actually about right, he said. And it's a matter of understanding, okay, if changes to, say, the main risk-based capital plan, the Basel III endgame, and to stress testing do occur as we expect, what do those changes look like? They certainly shouldn't be more onerous than today, but hearing that Powell say that capital is about right now makes me think, and for everyone here, they might be trying to sort of walk that tightrope about exactly how to make those changes.
And we already heard from Jerome Powell today. Tell us what else is on the schedule. For example, I see an interesting conversation coming up at 1 p.m. The Vice Chair for Supervision, Michelle Bowman, talking with the CEO of OpenAI.
Yeah, this conference is really Bowman's brainchild for her. She wants to hear from a range of voices, but the key voice that everyone's listening to today will be that of Sam Altman. Altman will bring a perspective that organizers say is a bit balanced and nuanced. You of course, expect advocates on one side and bankers on another side to argue about the right balance of capital, what the requirements should be. But Bowman's hoping that Altman would really speak to broadly how, by having the right balance with capital and other requirements for lenders, what that means for the economy, what that means for novel and new sectors, including, of course, artificial intelligence. And the hope is that it'll be a breath of fresh air from the debate about what the right requirements are, and more on what, if banks get it right, if regulators get it right, how society, how Americans really benefit.
Big taste of what we're going to get in the Bowman supervision era. Very interesting day. Bloomberg's Katanga Johnson reporting from the Fed. We thank you so very much. And for more on the banking regulatory landscape, we are joined by Tim Spence. He is the chairman and CEO of Fifth Third Bank. When you look at the Fed's policy right now, the big question too, first and foremost, is how much should they cut? Should they cut more than once this year? Should the president get what he wants? And even more than that, how do you feel about where rates stand today and whether there is indeed pressure on the economy given where rates are?
That's a lot of questions at once, Shanali, and a lot of very good ones. If I could, before I get there, I want to put a point on one comment that Katanga made that I think is really important, which is the right way to think about the capital framework for banks is the impact that it has on the real economy in the U.S. and that it has on Main Street people in particular, because the banks are a derivative of the real economy, and we play a really important role in money creation and the supply of credit that then supports investment in new job creation and home ownership and a whole variety of other things. And if you look at the capital, the impact of Dodd-Frank regulation forward, and you just look at the loan-to-deposit ratio for all regulated banks in the U.S. over the course of the past 15 years, it's declined from like 92% to somewhere in the high 67, 68% range. That's $4 trillion of credit that was not created to support home ownership, the proliferation of capital equipment to support domestic manufacturing and otherwise. So I'm quite hopeful that one of the things that's going to come out of this look at the Basel rules, that's going to come out of the relook at the stress tests and otherwise, is going to be the opportunity for banks to support the real economy, support people on Main Street a little bit better. Now, as it relates to interest rates, From my point of view, the Fed's always been focused on the right things. It's important that we promote full employment. It's important that we keep prices under control. And at least based on the way that the numbers are shaping up right now, I think inflation's been a little bit better than anybody expected. Unemployment has been, much better, I think, than everybody expected. There were a lot of concerns coming from the academics about the impact of higher interest rates on unemployment. But the labor supply has been tight, and the byproduct of that is, my view, and maybe we see a rate cut, maybe we see two, but we're unlikely to see a lot more than that this year. And that's certainly what we're telling our clients.
So there's a trade underway on Wall Street called the Powell hedge, a concern about the threats to the independence of the Fed. And part of that means, from a lot of investors, betting on lower interest rates on the short end, but a steepening, so higher interest rates on the long end. What's the implication of this, Tim? Do you see that the tit for tat is having a real world Main Street effect when you think about the future of the Federal Reserve and the pressure that the president is putting on it?
I think you hit one of the critical points there. I point out to folks all the time that we're not really a Wall Street bank. We're a Walnut Street bank. Walnut Street literally runs, perpendicular to our building, right behind me. And the right way to think about the questions around interest rates is the impact that it has on people and on Main Street businesses. So while the government is funding itself on the front end of the curve right now, most of the things that people care about, whether it's housing, owning a car, financing education, actually gets priced off of the belly or the long end of the curve. And the long end of the curve likes stability. It likes evolutionary change. And so, at least from my point of view, that's what's paramount to the average American, is that we ensure that mortgage rates stay stable, that they have the ability to plan around it, that education costs stay fixed, and you don't have a lot of interest rate volatility.
Let's talk a little bit more specifically about your business on Walnut Street. I want to ask about M&A. I know that on your earnings call last week, you pointed to a recent acquisition by Huntington Bank as an encouraging sign. What does that mean for your own strategy as you evaluate the landscape?
Yeah, I think what was encouraging about the acquisition that Huntington announced was the confidence that they expressed that they would get a quick approval. It's not good for anybody, but in particular the customers of banks who are involved in mergers or acquisitions, for there to be any uncertainty about whether an approval will arrive and how quickly that approval will arrive. So I did think it was quite encouraging that they expected that they would get a relatively speedy approval. As it relates to our strategy, we're fortunate. We have really strong profitability today. I think we finished the earnings season number one in ROE and number one in efficiency among our peer group, and in the upper half in terms of year-over-year revenue growth. So if there are no acquisitions for Fifth Third, things are going to be just fine for shareholders. But we have the least consolidated banking sector in the world here in the U.S., and banks are the least consolidated sector of any major U.S. industry. So there is going to be more consolidation over time. And I actually think that's a good thing for people.
Tim, there's a recent story in American Banker that I appreciated on why one regional bank is excited about stablecoins. Now, when the Stablecoin Genius Act was passed in Congress, there was a lot of concern about what it would mean for the regional banking system. Why are you not afraid? Why do you think that this is a good solution?
Well, I think you have to wake up every morning when you're in a period of technological change and make a choice between being afraid because the old ways of doing things are going to become less relevant, or being excited because you're going to be able to improve the way that you operate or the quality of services that you provide to clients. So I tell our folks all the time, if you want the future to be interested in you, you got to be interested in the future. And we are excited about it. From my point of view, we run a massive payments operation. We clear over $17 trillion a year in payments for folks. And anytime there's innovation on payments infrastructure, payments rails, it's a good thing for us because it means we have new services that we can offer to clients. We can take friction out of their businesses. And I think the thing I'm most excited about with stablecoins as it relates to our operations is just the ability to clear cross-border payments for folks who today would have to rely on Fifth Third referring them to a correspondent bank in many cases, and who would take currency risk, because of the delay in settlement and otherwise. So it creates an interoperability solution for multinational payment flows that just doesn't exist for a bank like us today.
That's a really refreshing note to leave it on. You can't ignore innovation. You have to wake up every morning and take a look at what's going on. Tim, got to leave it there. Really appreciate your time. That is Tim Spence of Fifth Third Bank. Meanwhile, let's take a look under the hood at some single stocks moving this hour, and we start with CSX. That's a railroad operator rising on a report that BNSF is exploring a takeover of a rival, perhaps that CSX. It seems that Warren Buffett poured some cold water on that, but certainly the sell side getting excited over the possibility.
The sell side is excited about the possibility. Hopefully the target needs a banker because Warren Buffett typically does not. Coca-Cola, I think this is interesting. Another discerning set of investors in terms of earnings season. They did beat estimates. They say cane sugar is coming this fall. Not enough to get people excited. Remember, in the Coca-Cola Pepsi pair trade, you actually had Coca-Cola running up more this year because of their domestic exposure versus Pepsi. So fun little fact, Pepsi actually doing better than expected this quarter.
There you go. We'll see if that mean reversion persists. Let's talk about NVIDIA, though. It shares down about 2.6%. Magnificent Seven stocks in general under pressure this morning. Remember, we get results from Alphabet and Tesla tomorrow afternoon. Maybe that will reset the narrative.
We will be waiting with bated breath because really we are just getting started with this earnings season. Coming up next, though, we are going to switch gears. We are going to talk to legendary venture capitalist Alan Patricof. He's on a mission to improve our golden years. And we're going to talk about AI and longevity next. This is Bloomberg Open Interest.
So today, are you confident that we can, with GLP-1 drugs, actually conquer and overcome the obesity problem?
I think this is the beginning of control of body weight, in much the same way that blood pressure was controlled over the years. We're having unprecedented success in treating patients now with the older medicines and the new generation of medicines. If you look at the earlier generation of medical treatments, we were able to get 2/3 of people to lose 5% or more of their body weight. With the latest generation, semaglutide and tirzepatide, we're getting 90% or 95%.
That was a peek at the first episode in David Rubenstein's latest series, Longevity, that premieres tonight at 9 p.m. on Bloomberg TV. And the legendary venture capitalist Alan Patricof knows a thing or two about longevity. For the past 5 years, the 90-year-old co-founder of Greycroft has been trying to redefine the science of aging with his venture firm Primetime Partners. It's a fund that invests in longevity technology. Now, the last time Alan was on with us, he said he planned on living to 114 years old. I'm pleased to say that Alan joins us now. Fantastic to have you back with us. And I want to talk about the landscape, because you started Primetime 5 years ago, and I think it's pretty fair to say that it was a nascent industry at that time. You fast forward to 2025. How has the industry as an asset class, and how has the opportunity set changed?
Well, first of all, I don't think we call it an asset class. I mean, that would be a little too much. I think that when we started 5 years ago, a few firms like ourselves existed, and no one was really focused on it. Today, jump 5 years, today there isn't a week that goes by that there isn't a conference, there isn't an article, there isn't a program on television like yourselves. And interesting that David Rubenstein's doing this special series on longevity tonight. So we have come a long way. I don't think we're at the point of an asset class. I think it's a subsection for a lot of the larger firms. Longevity has become a subsection of the healthcare area. But also, longevity not only involves healthcare, it involves financial security, for people to really be able to live longer and have the assets to do that. So that's one of the areas to focus on. And the other, of course, is enjoying living longer, staying healthy, and being able to do interesting things and keeping yourself active.
This is also something that really meets the demographics of the country right now. It's an aging population, and solutions to meet the needs of the population are also very necessary at this time. For somebody who's kind of looked ahead and started investing in this space, what are the types of companies that will start to succeed more and more as it's clear that people really, both families as well as caregivers, need more support?
Well, I think you're right on the button. I mean, there will be more people living over in the next 10 years over 60 than there will be under 18. So we're going to have an aging population. It's not just for this country, but we recently were down in South America. They're very seriously dealing with the problem. Whenever we think of aging, we think of China, Japan, Europe. So it's happening every place. And I think that the challenge of caregiving, the challenge of delivering medical advice to rural areas in particular is a challenge. If people are living longer, we've got to figure out how to take care of them, how to keep them well and service them, and to have the hospital and medical facilities as well as financial products that will enable them to live longer.
I'm glad that we're talking about caregiving, because you mentioned longevity, and I think most people just think, okay, we're in the business of living longer, but caregivers too are oftentimes an underappreciated part of this industry. And I know that you've invested around that fact. When you take a look at some of your portfolio companies, Carewell, for example, is focused on those caregivers.
Absolutely. I mean, caregivers are, you might say, unsung heroes. They're people who are devoted to the patients they have, sometimes 24 hours a day. They have to provide all kinds of services and also emotional support. A company like Carewell is focused on the products that elderly people need, and which run a whole myriad of items, not just the obvious, which of course diapers and bedpans and all the kind of support devices. But it's as you get older, you need different kinds of products to keep you functioning. And Carewell, as you picked out, is a leading supplier, and it's not the same as going on Amazon and asking for a product and getting well, first of all, you're not going to speak to anybody. It's going to be through some kind of internet connection. But in Carewell, you're probably dealing with a particular person who can analyze the problems and understand better what you need. And it's a much warmer feeling and more comfortable for the
Alan, I also have another question about another portfolio company that I'm very eager to ask you about, given what's going on with Medicaid in the wake of the discussions in Congress and the big, beautiful bill. And Sheer Health is a company you've invested in as well, where health insurance and medical billing is front and center. How has the demand for these types of services surged this year?
I don't think it's fair to say they surged. Sheer fills a very important need. We all get medical bills, and I don't know about you, but and you probably don't have that problem at this stage. But certainly, if you're in a Medicare or Medicaid position. But even if you have just plain old bills, it's very hard to analyze. And what Sheer does is, using AI and using every technique possible, it analyzes your health bills and shows you how to recover excess money that you may have paid, and how to avoid costs and to do it in the most efficient way. And it's meeting a real need. And I'd say certainly it's growing. But I think we really have not even seen the tip of the iceberg into how much that company can grow.
Alan, we appreciate your time today. I know we've talked about this a lot offset too, so excited to have you on to share this with our viewers. That is Primetime Partners chairperson and co-founder Alan Patricof. Katie, you also have been focusing on artificial intelligence in the healthcare world, and I think David Rubenstein is too.
Yeah, I'm really excited to see the premiere of this. That is premiering Longevity with David Rubenstein tonight at 9 p.m. New York time. And I know that Alan wouldn't go as far to call it an asset class yet, but you think about how many people are interested in this, both from a personal level, I want to live longer, and also as an investable universe. And it's been really interesting to watch it change and evolve over the past couple of years.
Yeah, there are a lot of people who want to see this fixed, especially if you think about the big macro ramifications, the questions about retiring later to try to fix some of this gap, and also, you know, big asset managers trying to figure out how to make that retirement money last longer. So a lot of implications, Katie.
Absolutely. And coming up next, we'll continue to keep an eye on these markets. A lot of pieces moving on this chessboard. This is Open Interest.
What do you think your mark is going to be as the CEO?
The trend of private capital, as significant as we think it is, if we look back again to 2000 to today, it's early days for private capital. If you think about the big trends, demand for infrastructure, demand for energy, the demand for defense, and really what's happening geopolitically, the demand for private capital will only increase. I'm also generally an optimist, so I think industries will grow, investment will grow, and private capital will just grow to be a provider of capital.
Spent many years at Goldman, now he's leading Carlyle. You can find the interview with Harvey Schwartz tonight. It's the season finale of Bullish at 6 p.m. New York time on Bloomberg Television, or streaming at 8 p.m. on Bloomberg Originals. Join the 1.5 million people that have already been watching Bullish. We're excited to bring you what's been actually my favorite episode, if I could choose one, Katie.
There you go. Wow, big tease for tonight then. You don't want to miss that one. 6 p.m. New York time on Bloomberg Television. Let's get a quick check on these markets while we wait, though. It's not too pretty. The S&P 500 down about 0.1%. It's big tech where all the weakness is. The NASDAQ 100 down about 0.5% right now, Sonali.
Getting a kick out of the Treasury Secretary taking his foot off the Powell pedal and the 10-year yield being a little bit lower. Stick with us. We have a big show tomorrow. Anastasia Amoroso, David Gross of Bain Capital, and, of course, preview.
Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Microsoft accuses Chinese hackers of exploiting vulnerabilities in its SharePoint software that have led to breaches worldwide.
Plus, OpenAI and Oracle deepen their Stargate data center partnership to power AI workloads.
but no sign of SoftBank to help finance the US infrastructure.
And NXP gives a not-so-bullish third-quarter forecast, suggesting the chip maker's still contending with a turbulent industry in the face of tariffs.
But first, we check in on these markets, Ed, that just come off of their record highs. Maybe a little bit of earnings anxiety is creeping in. Big day for Wednesday. Tonight, Texas Instruments and a key chip maker out of Europe may be dialing into a 0.5% fall on the moment on the NASDAQ 100. But you dig deep on the micro.
Yeah, earnings are giving us a state of play around the world. NXP Semiconductor, which gets more than 50% of its revenue from the automotive industry, not as bullish as the street was hoping for. Then you have GM, $1.1 billion hit to adjusted earnings from tariffs. The EV part of that story is a $600 million hit from EV inventory. That's a bit of a worry. Then we come out with Microsoft. Microsoft's our top story probably, in a blog post saying that state-sponsored Chinese hackers are behind what's happening. And in particular, the stock reacting negatively early in the session, Caro, normalizing a little bit, but we've got to get into it.
We do. Let's stick with that Microsoft story. Bloomberg's Jake Bleiberg joins us for the latest. And these are known state actors, 2 of them, and then 1 Chinese-based actor, it would seem.
Yes, that's exactly right. Microsoft said this morning that 2 groups backed by the Chinese government, Linen Typhoon and another group, have been responsible for some of the exploitation of this vulnerability in its SharePoint software. We've also heard from other cybersecurity firms that they're seeing multiple different organizations sort of hack into businesses and governments based on this vulnerability.
Jake, the top priority right now seems to be identifying the victims. Do we know what the kind of net result of this hacking activity is? Who's been impacted?
We know that the impacted organizations are ones that hosted SharePoint on their own servers, and that seems to be a real smattering of different groups, government agencies, businesses, other organizations all over the globe. We know that governments have been hit in the Middle East and in Europe and here in the United States. We also know of businesses and state-level agencies that have also been hacked into.
Microsoft, for its part, say investigations into other actors are also ongoing when it comes to the exploits. We can currently see what they've put out in a blog post. But more broadly, they acted swiftly to try and patch the issue. But once in a server, that is the key concern.
Exactly. We've seen warnings from cybersecurity companies that you don't just need to patch, you need to sort of hunt for whether your systems were penetrated and what they might have been taken. And a source told Bloomberg yesterday that the hackers, once getting in some instances, are stealing login credentials, usernames, passwords, tokens, and that suggests that they may be trying to exploit that information to launch other attacks.
Bloomberg's Jake Bleiberg out of New York City. Thank you very much. Meanwhile, shares of NXP Semiconductor are trading lower today. The company posting third quarter forecasts that were less bullish than investors anticipated. Then they went on to talk about the state of play in the automotive industry, which is 50% or more of their revenue. Bloomberg's Ian King, who leads our chip coverage, is here. It's actually a pretty simple story, right? Away from all the AI stuff, there's been a glut in inventory on automotive chips. NXP saying, look, it takes time to work through them. But for that industry and that key customer, the world's a bit uncertain as well.
It absolutely is, and we'll hear from Texas Instruments in a similar vein later today. The cross-currents are everything's supposed to be getting better. This kind of glut that we've had over the last couple of years is supposed to be going away. So we want, if you're an investor, you want them to be more bullish. You want them to be a bit more reassuring. That's not what happened from NXP. They said things are still hanging around.
And Ian, almost bullish is the wrong word for it when revenue is down 6% for NXP. And actually, revenues have been down quarter after quarter, right?
Yeah, I mean, what we'll have to look at, and this is why I think it's going to be useful to have Texas Instruments reporting today, sort of back to back, is this a customer-related thing? Is NXP basically supplying automotive companies that are struggling more than others? Texas Instruments is a much broader supplier, has a bigger customer list and a bigger set of products. So that'll give us a sense of whether this is a general automotive malaise, whether this is China related, whether this is Europe related, and we'll have a much clearer picture later today.
I am going to dig into this a bit later in the program, but the Philadelphia Semiconductor Industry Index, is underperforming generally, and Nvidia and AMD are big drags on that. The read-through between NXP and those two is difficult for me to see. But generally speaking, away from those kind of ultra specialized and even analog chips, things are quite robust still.
Yeah, I mean, we've seen, you talk about the index has done pretty well this year. Yeah. There's a lot of money has been put to work. Everything we've heard so far, and we'll hear more on that vein as the earnings season unfolds, is there's a lot of spending still going on these large AI infrastructure systems, and we've heard nothing that's telling us that that's not going to continue. And that's really what's going to be the most important thing, and that's what's driven the stocks so far. Analog has been a slightly different story, but again, analog benefits from this server build out as well. You need these power related chips, you need these microcontrollers as well.
Ian King, always with all the context, so appreciate it. Thank you. Now, let's dive deeper into the tech earnings, the vibe in the market right now. Anna Rathman's with us, founder and CEO of Grenadilla Advisory. Anna, your take here is that, yes, we're perhaps pulling back on the day somewhat, NXP not a resounding feeling of optimism, but we're still near all-time highs, and we've still got a $4 trillion Nvidia on our hands.
Yeah, good morning. Markets are definitely, the valuations are high. There's no slicing that in a different way. But I guess, you have to look at tech differently than we used to. So a lot of allocators and wealth advisors out there, we've been taught to look at tech as a growth sector. Perhaps it's more than that. So the AI component